Well, good morning, good afternoon, everyone. I'm Elliot, Kallen, CEO of Prosperity Financial Group, and welcome to a very exciting episode of Meet the Expert with Elliot Kallen. We have an economist on. We have a global market strategist on from New York Life. This is going to be for everybody listening, not just business owners, not just non-business owners, not just investors, but if you've got money and you've got money to work, or you've got a business that you're trying to figure out what to do, and tariffs of 150% on your products coming out of China, they're going to learn a lot today. So don't hit that delete button. We're talking with Julia Hermann from New York Life Investment Management. Yes, they're not just an insurance company. They've got a very large arm of investment management. Julia, welcome to the show.
Thanks so much for having me.
Great. Hey, so if you want to reach us, I'm at 925-314-8503, Elliot, Elliot, at Prosperity Financial Group. And this and about 125 more episodes of Meet the Expert are on our website at www.prosperityfinancialgroup.com. Come join us. Come be part of this. This is exciting. And if you want to hear or watch any of the episodes, if you've got questions, just reach out to me. We'd love to talk to you. It's very exciting. So we're in a world, Julia, of a tariff war, kind of in a little bit of a lull, except with China. We are in economic war with China. We've been there. I think it's just taken a long time to admit that we're actually at economic war with China, but we've got it. Thankfully, we're not in the middle of World War III with 20 million people dead, but we are in economic war, and it could turn into something much worse. But we're not going to talk about geopolitics here unless it relates to economics. So let's just talk about what's going on in the tariff war, the potential for some treaties coming out in the next few weeks. The rumor is India. It's only a rumor. I don't know probably any better than you do. But what do we do? I'm a business owner. I'm an investor. I'm getting hit with unbelievable volatility, things that I've never seen in my lifetime. How do I deal with this?
Well, here's the thing. I do believe that we are at peak policy uncertainty today in general. And frankly, if there wasn't market volatility right now, the market wouldn't be working quite right? So we are in this moment of peak uncertainty. But I wonder if before we go into, the tariff specifics and our macro outlook, if we could just spend one quick moment on context here, because I think that there is a bit of a pattern that's happening that permeates everything about the outlook right now. That reality is that we have now had two economic cycles in the US that have not been able to end organically or naturally. So the first of those cycles was ended by the pandemic. If you think back to January 2020, what was happening back then? Everyone was wondering if we would have a recession in the US or not, right? Interest rates had come up again, but that didn't get to conclude because we had the pandemic shock. Now, if we think back to January 2025 of this year, everyone was wondering, are we going to get a soft landing? Are we going to be able to avoid a recession or not in that come down from the pandemic period? And once again, we'll never know because we have now had this policy disruption and these tariffs. So as we ask these bigger questions today about tariffs, about the outlook, and in the context of broader global questions about, preference or lack thereof for US assets, questions about the outlook for inflation and interest rates, questions about how we can all anchor our portfolios, it's more than just about policy uncertainty from this administration. It's a fact that we really haven't had a strong, meaningful reset of the economic cycle in well over 5 years, really since the come down from the global financial crisis.
So now let's go. I get what you're saying, and I don't think anybody wants to hear about a reset, because that means their money goes down, and then starts going back up. But with what we have to live with, that we know that we're definitely, as you said, in uncertain times. Trump is trying to rebalance trade out. I think we all would agree that he's doing it kind of with an axe or a blunt instrument instead of a surgical tool, but he's doing what he's doing, and it shouldn't surprise anybody. And maybe at the end of this, we come out all better for it. Let's all hope that, cross our fingers, that we do come out all better for it. How do I, as a business owner, prepare for tariffs? I'm a global business owner. I'm an investor. How do I prepare, and what should I expect?
Well, I completely agree with you that we're facing more of a broad reworking in how the economy works. And frankly, no one knows at this point if this new way of thinking, or this experiment, if you will be successful, if it's a really great way forward, or if it's something that's not really going to work. What we do know is that we're at that transition point right now. We're at that moment of peak policy uncertainty, really intense volatility. And so how do you navigate this transition point, given that, no one can have a credible outlook for 12 months from now? No one can have a credible outlook for 2 years from now, because that confidence interval or that range of potential policies is just too big. So as investors on my end, or business owners in terms of the audience of our conversation today, we do know a few things. We need to focus on what we know. One of those things is that we expect the tariff rate to be significantly higher than it has been at any point in the last 100 years. And that includes expectations for negotiations with trade partners. It even includes an expectation that the US and China will have to come to the table at some point. And so as investors in my world, we're having to look at ways to build resilience, to reconsider diversification. And frankly, there are a lot of US investors specifically that need to come back to that diversification conversation. We also, though, need to remember that there has been a big, bright, shiny spotlight on tariffs recently for obvious reasons. But there's a bigger policy shift going on. And frankly, the attention to tariffs that's been happening might shift overall. One example is that there's a tax bill going through Congress right now to potentially extend the Tax Cuts and Jobs Act of 2017. In other words, the Trump tax cuts, right? Those are potentially a boon to the market, potentially a boon to the consumer. We also see expectations for greater deregulation, which could also be more favorable to the market. So we just need to keep in mind that in this transition point, volatility is going to work in both directions. And that means that we need to consider how to build ballast against that across the entirety of an investment portfolio, at least considering things from my world, which is one of investments.
Well, you bring up a great point, and we're talking with Julia Hermann from New York Life Investment Management, and she's a global market strategist and economist, undergrad at Notre Dame, graduate school at Johns Hopkins. We're not going to spend any time knocking Baltimore here. They could do that without us. But she brings up really good points, and that's portfolio planning. If you need to reach me, I'm at Elliot, ELLIOT, at prosperityfinancialgroup.com, with the website being prosperityfinancialgroup.com. It brings up building portfolios. That's what we do here for a living at Prosperity Financial Group. That's why we created this show originally, to reach our clients back in 2021 when we were all shut down. And we thought, okay, we got to be able to reach people. And we build 7 portfolios using different models, and we tweak them almost every week with where we think the puck is going, so to speak, in a hockey phrase. We want to be in front of what's going on rather than behind it. And it's getting more difficult, obviously. And we are more diversified. I just talked to Tom, who's my local rep from New York Life out there. There's a plug for Tom. And he was telling me that how international is beating domestic so far this year, which hasn't happened in a better part almost of a decade, that international has been winning. And granted, we're only on the first day of May here, so we got plenty of time for the year, or 3 years or 5 years. But is that a global trend, that the U.S. is going to be potentially softer than the world, which has not been around for 8, 9, 10 years now?
Yeah, I mean, frankly, when I talk to US-based investors, traditional portfolio construction would suggest that about 20% of an equity sleeve would be allocated to international equities. That's the classic textbook version. But when I talk to investors based in the US, I have heard a range of international exposure from 0% to 12 or 15%. So really, really, really steep, very decisive underweights to international equities. And candidly, it comes from the fact that international returns, international earnings growth hasn't given US investors much of a reason to care in the past 10 or even 20 years. But we're seeing that shift, I think, because of both tactical reasons and structural reasons. So I want to get into both of those. On the tactical side, or the shorter term side, many investors, the global community of investors, has really taken to heart that the US had previously been priced to something close to perfection in terms of earnings growth that it's able to deliver, in terms of leadership in artificial intelligence and technology. And valuations became the number one concern for US equities. And frankly, on a relative valuation basis, the case had been there already for investors to consider greater international exposure. So that's the tactical side of things. The more structural side of things is that, over 2/3 of global market capitalization, or the size of total equities of the world, over 2/3 of that is based in the US right now. There's this huge amount of concentration just in US capital markets. And we have seen investors question that, is the power of is US policy as powerful as it has been in the past? Is US earnings growth going to be as strong as it has been in the past? And that questioning has allowed for some opportunity for reallocation toward international opportunities. And Europe has been a pretty big beneficiary of that. It's also not just equities. We've also seen it on the fixed income side in terms of both hard currency or dollar denominated global debt and even local currency global debt. So all of this to say, I do believe that this reallocation has legs, not only because we have a mathematical attractiveness that international equities have relative to the US, but because this trend has staying power. This trend has bigger questions behind it, which frankly, Elliot, goes up to what I mentioned at the top, which is we've now had 2 cycles that haven't been able to fully end organically. And this has been a time for investors to really wonder what can anchor their portfolios.
Well, let's talk about China for a moment, because they are the 800-pound gorilla in the room, China. No question about that. And we'll argue whether we go to war. I worry about my grandchildren going to war with China, because I see some parallels of the 1920s with Japan and some today's times with China. But again, that's a political discussion. But I do know, this is a typical story. I've got a business owner who does a lot of packaging materials and packaging. And he imports what we would call cardboard boxes, but boxes from China. That's his number one supplier. And he said, I have to lay off 1/3 of my staff now to make up for my increase in materials, because I can't now produce these materials, and I can't shift tomorrow to the US to do this packaging for me. I have to make it in the Far East. What do we tell this guy? Is this something that is temporary? Is this something that he should have just gone to the bank and borrowed 4x on his money and buy more packaging materials just in case ahead of the tariff? How does he handle it like other business owners who are going to experience the same thing?
Well, first of all, we do have data that shows that a lot of not just businesses, but also regular consumers have been trying to do just that. They've been pulling forward their purchases, trying to get ahead of tariffs. I myself did that. On April 3rd, I went out and I upgraded my iPhone, which had previously been a very clunky old one, and I expected it to increase in price. So I went ahead and got a new one ahead of the tariffs. So I think it's a very natural instinct. When it comes to these tariffs and the temporariness of all of this, trade questions have been around for quite some time, right? Of course, we had the trade war in 2018. I think that the COVID-19 pandemic is the reason that supply chains are so now commonly understood to be such an important issue, right? And of course, this latest round of tariffs makes the choice very stark. It makes the economic and cost difference for business owners like your friend extremely stark. It's also a reminder of the fact that supply chains are not as flexible as we might like to think that they are, especially when people sitting in a seat like mine look at the 30,000-foot view. Sometimes people say, oh, why can't this just move to Vietnam? Or why can't this just move to Mexico? But that's not how supply chains work. And with China specifically, no one has achieved scale in export capacity like China, especially for lower value add items like boxes, but they can do volume like no one else does. And candidly, there is no solve for that right now. The near term is that importers will face a higher cost right now. In addition to these questions about supply chains, which frankly, I don't think that anyone can really credibly answer at a time like this until we get an end effective go forward tariff rate. We're also getting questions about what does this broader decoupling between China and the US look like? Is China going to dump its treasury holdings? Are we potentially looking at conflict in Taiwan, right? So there's bigger questions here, which we can also discuss. But for the near term, we don't have supply chain flexibility that will allow for a very, very quick fix when it comes to costs for US importers.
Well, that's a great point because you bring up what I think is a general misnomer that we hear out of in political discussions, and that is that these companies are going to make investments in the U.S. and move their factories to the U.S. And by next year, we'll have new product. And you know that some of these factories take 2 to 5 years to build. They do. If you want to build a chip factory in Ohio, it's a couple of years to build that chip factory. If Taiwan Semiconductor feels that they're in danger in Taiwan and they want to move to Ohio, and I'm picking on Ohio because it seems like Ohio is, soliciting to be the chip capital of the United States. This is going to take years to come up with the Taiwanese chips, which are the most popular chips in the world. And it would make sense for them to do it, or manufacturing plants and things like that. If Trump wins, he won't even be in office when one of these things hits, is successful, because these plants will probably, maybe a handful of them will come online while he's still president. And the rest would be, the next president will be enjoying this, whatever party. And that's generally how it works anyway. Investments today pay off sometime in the future. But if he is right, we are looking for a U.S. economic boom. Even if the majority of products we make are going to be robotically oriented, we're not going to make sweaters in the U.S. We're not going to start making T-shirts from Vietnam in the U.S. The commercials that show these people trying to assemble, sneakers, Nike sneakers in the U.S. and they can't do it. It's kind of a joke on YouTube. That's not going to happen. They may not be made in China, but they're not going to be made in the U.S. What could be made in the U.S. are things that don't require massive labor and can be very automated, such as automobiles and things like that, and car parts and stuff like that. And obviously, more and more drilling and so forth. That's a case for investing more in the U.S. and less internationally, or investing internationally only in those countries that stand to continue to grow, like a Vietnam, and is the beneficiary of China decoupling, would be a beneficiary for Vietnam, as maybe Mexico. When this is all settled, Mexico and China could be the big winners.
Well, what is the case
I mean,
for?
Mexico and Vietnam, Mexico, Vietnam.
Yeah, well, Elliot, what I think it's a case for is diversification, right? Um, we have done a lot of work on supply chains generally. We actually did it several years ago. And we see a big case, not necessarily for reduction in total global trade, or what one might call deglobalization, but what we would instead refer to as something more like reglobalization, a refinagling of all of these supply chains. But I think the through line for US investment, and this is independent, frankly, of tariffs, these are trends that we have seen develop over the last many years, is that we see major waves of investment hitting the US right now in a variety of different ways. Refinagling supply chains is one of them. Tariffs are, of course, a near-term trigger for that, but it's bigger. Let's think about the pandemic. What did we learn in the pandemic? We learned that national security is not just about defense. We learned that it's about access to key healthcare supply chains, access to vaccines, access to rubber gloves, access to key food and consumer staples supplies, right? So bringing some of those critical supply chains back home is a trend that had already started, and we would expect it to continue. It's very capital intensive, and frankly, we see it as a very long-term investment theme. There are two other portions of that I just want to mention that add to this broader environment of higher investment, maybe higher inflation in the US in the medium term. The first is energy independence. We're now the world's largest energy producer, and a lot of that started when Russia invaded Ukraine, and we realized that we wanted to be more self-reliant. Finally is the tech side of this. You mentioned that, if you want to build a computer chip factory, or they're called a fab, in the US, it's going to take several years, but that has started. And It's the tip of the iceberg, but there's definitely more of an acceptance that we need to build more digital infrastructure, more capability to build our own chips at home. And it's a matter of access to all the stuff that we need when the chips are down.
It's funny, you talked about globalization. I've had for a while now 2 to 4% of my growth portfolios in India. And nobody really talks about India. I mean, it's the largest growing democracy on the planet. It's got the most potential for capitalism. It does have a graft problem and a bribe problem there. That's the same problem, by the way, that Ukraine has had in the past, is bribe and graft and so forth, and why people shy away when every day you're being asked to put more money into other people's pockets instead of your own. But is India a place that has an unbelievable potential, but warning signs flashing, or is it someplace that the warning signs are no longer red, they're yellow? What is going on with India?
Yeah, so I spent the first 5 years of my career in emerging markets. And as you might imagine, China and India took up the bulk of my time in those years. Um, I can mainly speak to this from a relative global perspective. I've gotten a lot of questions about why is China China, meaning very successful, very rapid growth, developed extremely rapidly. Why is China China? And then why is India India? Roughly the same population size, right? They've been developing pretty rapidly, just not as comprehensively as China. They haven't had the global trade position that China has. Why is that such a huge difference? Frankly, it might come down to how they each developed. China had this very comprehensive land reform that meant that the economy could be a little bit more centrally planned. India has not had that, and that creates some red tape. And it, exactly to your point, it has contributed to a more difficult business operating environment in India. Generally speaking, though, I have seen really incredible companies in India precisely because the operating environment isn't quite so easy. You see an incredible demographic surge supporting India in a manner that not just China, but most emerging markets don't have that demographic tailwind anymore, but India does. So, from a relative perspective, I see a ton of potential there. We've seen moderate levels of reforms that would get India a little bit more ready to accept some of that supply chain reglobalization from China. But it's a little bit slow moving. So incredible potential there, but probably more of a medium or long term view.
Okay, we're talking with Julia Hermann from New York Life Investment Management. Don't hold this against her, but she's got a master's from Johns Hopkins in international economics, and she's a chief global market strategist for them. And we're having a great discussion about what's going on globally. If you're a business owner and you're trying to expand or maintain your market share, you want to know what's going on around the world, because if you're not global, your competitors are. And then if you're an investor, this is what we do. Give us a call and let's talk about your portfolio, whether it's with us or not with us. We could show you how we work it and how we are active money managers here. I want to talk to you about the poster behind you, or the banner behind you, about basically the United States and North America and South America, and the Gulf of America or the Gulf of Mexico, that your head is blocking whatever's written on there, which I find more humorous than I find serious on that. So we don't need to talk about that one. But I don't understand something economically here. I get Canada. Canada is a highly skilled workplace, but is overpriced in many ways, like the United States. You're not going to have inexpensive products made in Canada. The United States is the United States, but you've got then from Mexico running south, you've got inexpensive labor, very inexpensive labor, almost third world price labor in Mexico. You've got a lot of Americans that's going down there back and forth. It's exceptionally easy access from the United States, from almost anywhere, to go to major cities, not just on the coast like we like to vacation, but internally inside Mexico, where you could manufacture, and you do. And then you've got, not that much further down the line, you've got South America, which could be for us the far east of the Western Hemisphere, with inexpensive labor. They're dying for American jobs down there. Why don't we as a country pump more money in there? Because I feel like it's been stalled out and all the money's been going to the Far East.
Well, Honestly, we could probably talk about that specific one for hours, but let me break that into a few pieces. First, on the Mexico side, it's one of the US's very largest trade partners. So we do have a huge amount of interaction with the Mexican economy in terms of auto manufacturing, as just one example. So we have a huge amount of interaction there, and Mexico could well be a beneficiary of these tariff and supply chain questions because we have the trade agreement to underpin all of this. And that trade agreement is the USMCA, or the new version of NAFTA. In terms of Latin America more broadly, unfortunately, it kind of becomes a little bit of a history lesson. We have a lot of economies there that are resource rich, whether that's oil, whether that's copper. And because they had historically had that as a source of wealth, a source of what they can export, they didn't necessarily industrialize in the same way that many areas in Asia did, or even Eastern Europe. So frankly, it's probably more of a legacy question than anything else. And I do believe that the next few years will give us the answer. Just how agile are supply chains? How easily can you pick up manufacturing capacity, especially depending on what it is, and put it somewhere else? How much will these tariff negotiations influence choices like that at the corporate level?
Well, it's a fascinating subject. I know we could talk about that all day. We're talking with Julia Hermann. If you need to reach us, we're at 925-314-8503. You're on Meet the Expert with Elliot Kallen, and it's ELLIOT at prosperityfinancialgroup.com. And about another 130 or so episodes are on our website. Let me ask you one more question, and you've been great about giving us your time, and really appreciate that. And that is, you're not picking. You can't pick winners or losers. Nobody can pick winners or losers, and I won't put you in that spot to have to pick winners or losers. It's very interesting. I think everybody who listens to this would probably say the big winner is going to be in the U.S. Probably energy. They're going to have a lot of drilling or more alternatives for energy. Yet, when during Trump's presidency, the prices of energy went down, and so did the value of their stock go down. So we got lower gas prices, which helped everything out, but maybe not the best places to invest. But what did work out really well, and what can work out really well, is if a handful of countries, doesn't matter whether in Europe or the Far East, but they come and they say, hey, we want you to do business here. We're open for business. Come bring your products to France. Come bring your products to India. Come bring your products all over the world. And that is what we're going through right now with tariff heaven or tariff hell. If that does happen to work, and Trump ends up being correct, and we have 20 treaties in the next 90 days here, we're on our way to 20 treaties, tariff treaties. Does that represent a manufacturing boom to the United States? And then it becomes, wow, I don't want to miss this. I've got the fear of missing out moment. I better start investing more money.
Honestly, I think that until we have the 90-day tariff pause end, which will happen on July 7th, happens to be very close to July 4th, a great time for a president to make big announcements about what's going on. Until that point, I think that the range of potential scenarios past then is simply too large. So then what do we do in the interim when we're figuring out who would be the more likely winner and loser here? In the US markets, I think it's more helpful to focus on investment principles and investment themes as opposed to sector selection. One example on why sectors might be a little bit less helpful to us right now is exactly your point, energy. Energy is a typically more cyclical sector, right? And so when the economy is decelerating, as it is today, that would typically be something that investors would stay away from. However, exactly to your point, we see a lot of reasons for the US to be leaning into energy independence. We also see huge energy needs stemming from our investment in digital infrastructure, trying to make sure that we lead on the artificial intelligence side of things. So simply classifying energy as a cyclical asset class that does better when the economy does better is less helpful right now. What I think is very helpful is focusing at a time like this on quality. Now, quality is easy to talk about, but what do we actually mean? In equities, I'm talking about strong earnings growth, or at least resilient earnings growth. I'm talking about really strong coverage of any debt obligations. And frankly, a very straightforward way to consider that theme, implementing it, is with dividend yielding equities. These tend to be larger cap or larger companies that have a bit more of a buffer against the cycle. They tend to be value companies, so really nice, strong, stable business models, and they tend to protect that dividend with everything that they have got. Then quality in credit is the same question. What are the companies or the areas where all this policy uncertainty and higher tariffs is not going to affect a company's ability to pay its debt? And in that sense, of course, now can be an interesting time to consider investment grade corporate credit. It can be a great time to consider taxable municipal bonds where we actually see a lot of credit quality. But it can also be an interesting time for high yield corporate credit because we are seeing the difference in spreads between high yield corporate credit and risk-free credit or treasuries. We're seeing that get wider. And frankly, it can be a moment where that creates a lot of value for investors and actually an opportunity to participate in a, relatively speaking, high quality asset class where we don't expect tariffs to create a systemic credit quality problem.
Wow. So I want to tell you, Julia, I give you a lot of credit. You're not one of these old white men with white hair with a mustache on TV on Fox and CNBC that, their best days are 20 years ago, or they're teaching at, NYU. And, that's the reason for we're on. You're young, you're dynamic, and you're interesting to listen to. So good for you. If you've got a child, a boy or girl that's going to college or getting ready to go to college or grad school, and they're wondering what to major in, Julia's a role model on what happens when you major in international economics. And you move forward with that because she's got her act together. And she spoke recently at one of our dinners in Danville, California. And I want to tell you, Julia, I probably received the most compliments about you that I've heard about any speaker we've ever had. And the compliment was, she is so confident on her feet that she could talk about any subject and can take any question, obviously about the topics we're talking about, but can take any subject there. And she's willing to attack that and say, I'm sorry, I don't follow that, so I can't talk about it. You're willing to do that. So congratulations to you for your confidence and your answers and your expertise, because people like to hear it.
Thank you so much, Elliot. That's so kind.
Good. So if they want to reach you or they want to reach New York Investment Management, obviously to reach us, to reach me is 925-314-8503, or the email address that I've always said a few times. But if somebody wanted to get an expert answer from New York Life Management, are they allowed to do that, or should they just call me?
They can always call you, but they can also get in contact with our teams. A few ways to do that. The first is through LinkedIn. My name is Julia Hermann. The last name has 2 N's in it. You can follow myself and my team members, and that can give you a nice drip of our weekly views. And more broadly, if you want our research on supply chains, artificial intelligence, or just our latest macro outlook, everything is available at newyorklifeinvestments.com/global-markets or newyorklifeinvestments.com and just go to the global markets page.
Great. And we didn't really spend any time talking about artificial intelligence. We've got lots of Meet the Expert podcasts about that, but it is the wave of the future, whether you're scared of it or not scared of it. I was just telling we're getting ready to start another company on top of what we're doing. And I've started now 5. And I've told everybody who's thinking about coming to work for me here in this other company is make sure you embrace artificial intelligence. It's not your enemy. It's your friend. Now, it may put us all out of business at the end of the day. I'm not sure about that. But it is our friend, and it will just become a bigger and bigger part of our life. And I'll give you an example, Julia, and I love your comment on that. Part of the business that we're starting includes wine and dinner and travel. And I sat over lunch with somebody who's in the high-end travel business, the kind of thing that you and your family order a G7 plane to get to London from New York and private tours and all around and drop a quick $100,000 in 5 days. That's the kind of tours he does. But he said, I want to show you something, Elliot. And he pulls up his phone, not an iPhone, nothing fancy about it. And he pulls up his his AI program for GLP-4 and says, give me an article about Pinot and why I should begin to market Pinot and Burgundy in the United States and make it no less than 2,500 words. And his phone pinged 5 minutes later with a 2,500 word essay on the value of distribution of Pinot and the U.S. Pinot and French Burgundy in the U.S. market and the best places to do this. I thought, wow, I could research that in a fraction of the time.
That is amazing. One of my favorite ways to use the AI chatbots is actually to decode a cocktail menu. Because whenever a cocktail is listed, there's 5 ingredients and I don't know what they are. But if you put that menu into an AI chatbot, it'll decode it for you and say, oh, this is a martini by another name. And it's just a fun little way to integrate it into your evening.
It is. I love that thirst for knowledge. When my mother died, on a quick story, she was Austrian and she came here after being in Auschwitz, an Auschwitz survivor from Vienna. And English was her third language. And she always had a heavy accent. I didn't hear it as her son, but she always had a heavy accent. And she would listen to talk radio all night long because she was a terrible sleeper. And she kept a dictionary by her bed with a light on. And when she heard these words she didn't know, she'd look it up. And that's how she built her vocabulary out. We buried her with her dictionary in the coffin because she was kind of like what you're talking about. There's a genuine thirst for knowledge. And if you embrace it, whether it's artificial intelligence or just general knowledge or things that you don't know, you are going to just exponentially grow your sphere, both intellectually and the people that you want to hang out with and associate with all the time.
What a beautiful story, Elliot.
Yeah. So thanks for being part of Meet the Expert with Elliot Kallen. Again, you can see these episodes on www.prosperityfinancialgroup.com. Come join our family. Come join us. If you've got questions about your portfolio, how some of Julia's comments fit in with your portfolio, whether we're managing it, or you just want to get a second opinion, it's what we do for a living, everybody. I've got 2 companies here, manage about $1 billion between those 2 companies. That makes us a fairly sizable character in the United States world of investment management. We've earned it and we love doing it and we're passionate about it. So Julia, thank you so much.
Thanks so much for having me.
We'll see you again real soon, everybody. Have a great day.